All right, in this economics video, we're going to visit some topics that we didn't get a chance to look at yet when we went through aggregate demand, like average propensity to consume and marginal propensity to consume. And these are terms you see on the exam, so you got to know what they mean. So let's review aggregate demand. Aggregate demand measures total spending in the economy. Aggregate demand is the sum of consumption spending, which is consumer spending, investment spending, which is business spending, and government spending. And tack on to that net exports, which means exports minus imports. So here's how you would measure aggregate demand, or total spending in the economy. You got consumption spending. If that were 10, it would probably be 10 billion. Investment spending, if that was 6 billion. Government spending, 3 billion. Net exports, 2 billion. That implies that exports are greater than imports. And your aggregate demand would add up to 21 billion. Now, instead of net exports of 2, if it said in the facts that you had net imports instead, then you would have to recalculate. And if net imports were given as 1, then you would actually subtract 1 instead of adding the 2 for net exports. If they told you net imports were 1, then the whole thing would look like this. You'd still have the 10, the 6, and the 3, but then you would subtract 1 for net imports, and your aggregate demand would be 18. And the reason for that is if U.S. exports are greater than imports, then that's positive, because that's going to result in an increase in aggregate demand in the United States, since we're spending less money overseas than they are spending in the United States. So they, being foreign countries, will be spending more money in the U.S., and we as U.S. citizens would be spending less money overseas. That's considered positive for U.S. aggregate demand. Now, if U.S. imports are greater than exports, that's the opposite. That would be negative. That's going to be a decrease on aggregate demand in the U.S., because that means we in the U.S. are spending more money overseas than they are spending in the U.S. And unfortunately, the U.S. has been a net import country for the past 2 decades and is now the world's largest import country. So our aggregate demand would likely be measured this way, with a -1 for net imports, as opposed to this way, a +2 for net exports. The other items that make up aggregate demand, we're going to take a look at one at a time, starting with the most important, consumption spending. Consumption is the spending by individuals on final goods and services, but not new residential housing, because that's considered investment spending. Remember, investment spending is one component and consumption is a different component. So consumption is the spending by individuals, but it doesn't include new residential housing. They could ask you that on the exam because new residential housing is included as investment spending. Consumption accounts for 70% of all spending in the United States. So that means the consumer is the biggest spender of all in the U.S., bigger than government, bigger even than business spending. We're talking food, clothing, shelter, medical, even durable goods like refrigerator, washer and dryer, new cars purchased by consumers would be part of consumption, but not new residential housing. Now, since 70% of all spending is done by consumers, jobs are so important to U.S. economic performance. If people in the U.S. are earning wages, they can continue to spend money, and there's a direct relationship between those wages and consumption. What does that mean? There's a direct relationship between wages and consumption. It means as people earn more, they're going to spend more on consumer goods. So let's try this. Aggregate demand in the United States would likely increase as a result of, A says a decrease in government spending. No, if the government spent less, aggregate demand would actually decrease. B says an increase in imports would likely increase aggregate demand. No, increase in exports would increase aggregate demand. Decrease in business investment? No. Aggregate demand would likely decrease as a result of a decrease in business investment. So it's got to be D. An increase in consumer spending. Aggregate demand in the U.S. would likely increase as a result of an increase in consumer spending. D is the answer. All right, aggregate demand in the United States would likely shift left as a result of an increase in, well, first of all, shift left means decrease. Aggregate demand in the U.S. would likely decrease as a result of an increase in, A says imported goods. Yes, because more imports means that more money is being spent overseas by U.S. citizens compared to the money that foreigners are spending in the U.S. So that's going to result in aggregate demand shifting to the left. So A looks good. B says an increase in government spending. No, that would shift to the right. Aggregate demand would shift to the right if the government spends more. An increase in business investment spending. Aggregate demand would shift right. And an increase in consumption spending. Aggregate demand would shift right. So A is the right answer. All right, how about this one? Aggregate demand in the U.S. can be described in macroeconomic terms as the sum of, A says consumption spending, investment spending, government spending, and net exports. Yeah, that looks pretty good. B says consumption spending, investment spending, and net exports. Yeah, but what about government spending? Yeah, it's not in there, so B's out. C, consumption spending, government spending, and net exports. What about business or investment spending? So C's out. D says government spending, investment spending, and net exports. What about consumption? So A has it all. Let's go with A. All right, now it's going to get a little more sophisticated as we move on to what's called the consumption function. And the direct relationship that we said exists between wages and consumption, the more you earn, the more you spend, that's referred to as the consumption function. And the consumption function measures the relationship between income and consumer spending. Consumption function answers the question, how much do consumers have available to spend versus how much do they actually spend? Because income is taxed, so it's only the amount of income after tax that is relevant to spending. And the amount of income after tax that is relevant to spending is what we call disposable income. So consumption function is going to measure the relationship between personal disposable income and consumption spending. Can a consumer ever spend more than personal disposable income? Yes, but they would have to borrow to do it, or they could spend pre-existing savings. If a consumer did spend more than disposable income, CS would be greater than PDI, consumer spending would be greater than personal disposable income. But to do it, you'd have to borrow or spend savings. Otherwise, consumer spending would be less than PDI, less than personal disposable income. And if that's the case, the difference must be going into savings. So we're going to measure the average propensity to consume, or APC, and the exam could ask you to calculate it. The average propensity to consume measures the percent of disposable income spent on consumption. So, for example, if PDI is $1, if that's what you had available after taxes, personal disposable income is $1, and you wound up spending 90 cents of it, then average propensity to consume is 90%. And since 90% of the disposable income was spent, only 10% was saved. Therefore, the APC, average propensity to consume, would be 90%, and the APS, average propensity to save, would be 10%. And they're reciprocal of each other, and together they have to add up to 100%. So here, if gross income equals $67,000 and disposable income equals $50,000 and consumption spending is $45,000, calculate the average propensity to save. The gross income of $67,000, that's not important. That's just a distractor. So it's the $50,000 of disposable income compared to the $45,000 of consumption you're spending most of your disposable income and saving only $5,000 of the $50,000, and that will be 10%, right? Because you're only saving $5,000 of the $50,000 since you're spending $45,000, and $5,000 over the $50,000, that gives you an average propensity to save of 10%, which is letter C. If they would have asked for the average propensity to consume, then you would have taken 45,000 over 50,000 and you would have got 90%. So you got to just be aware of what they're asking for. And note that APS plus APC equals 1, or 100%. So let's be aware that disposable income depends heavily on the tax rate. If taxes were to increase, disposable income would decrease and consumers would spend less, and that would decrease aggregate demand. So which of the following is most likely to decrease aggregate demand? A says a decrease in tax rates. No, a decrease in tax rates would have the opposite effect and would increase aggregate demand. Increase in tax revenues. That's likely to decrease aggregate demand because we said an increase in tax revenues means you're paying more in taxes, you have less disposable income, less to spend means aggregate demand shifts to the left. So B looks good. Increase in export revenues, that's an increase in aggregate demand. An increase in business investment would also increase aggregate demand. So B looks like the best choice. How about this? If tax collections and interest rates stay the same, an increase in government purchases will result in what? So we're not changing anything else, but an increase in government spending, that's going to increase aggregate demand because the government is a buyer of goods and services too. And as the government spends its money in the economy, that's going to result in an increase in aggregate demand. Letter A. It's not going to do anything to supply, but it's going to increase aggregate demand. All right, which of the following is the primary determinant of consumption spending? What's the primary force behind consumer spending? And the answer is personal disposable income, letter C. Because as consumers have more disposable income, they will spend it. C is the best answer. These other choices, they are measures of aggregate demand, but they don't belong in the consumption side. So just know that personal disposable income is the primary determinant of consumption spending. There is a direct relationship between a person's disposable income and how much they actually do spend. And we called that direct relationship the consumption function. And within the consumption function, we looked at the average propensity to consume, and we said that's a measure of consumption. If PDI, or personal disposable income, is $1, we said, and if consumer spending was 90 cents of that dollar, then the average propensity to consume is 90%. Why? Because you had $1 and you spent 90 cents of it. You had $1 that was available to be spent, and if you spent 90 cents of it, then your average propensity to consume would be 90%. Another measure of consumption is marginal propensity to consume. So that was average propensity to consume. Now let's get to know marginal propensity to consume. Marginal propensity to consume measures the change in consumption spending as a percent of the change in disposable income. We already know that there's a positive relationship between disposable income and spending, but if $1 of additional disposable income is received and 85 cents is spent on consumable goods, then the marginal propensity to consume is 85%. And then the marginal propensity to save would be the other 15%, or the reciprocal of marginal propensity to consume. So marginal propensity to consume says you earned $1 additional and you spent 85 cents of it, then the marginal propensity to consume is 85%, and your marginal propensity to save would only be 15%. Once again, the two would have to add up to 100%. So here's the kind of question you might see on a CPA exam. If disposable income increases from $100,000 to $120,000 and consumption spending increases from $90,000 to $106,000, calculate the marginal propensity to consume. So you had the increase in disposable income, and as a result you spent more, what's your marginal propensity to consume? Income went from 100 to 120. Spending went from 90 to 106. We can see that the change in income is plus 20,000. The change in spending is plus 16,000. And what we would do is we would divide the 16,000 change in spending over the 20,000 change in income, and we'd see that we have an 80% marginal propensity to consume, and that's what they asked for here. The marginal propensity to consume, 80%, answer choice B. If they would have asked for the marginal propensity to save, it would be the $4,000, the change in savings divided by the change in disposable income. 20% would be the marginal propensity to save, but they didn't ask for that. All right, let's try this one. During year 19, this time they are asking for marginal propensity to save. During year 19, Gil's disposable income was $50,000 and he spent $45,000 on consumer goods. During year 20, his disposable income increased to $100,000 and he spent $75,000 on consumer goods. What's his marginal propensity to save? Not to consume, but to save. And you can see that disposable income is up by $50,000 and consumption spending increased by $30,000 and savings went up by $20,000. So they want marginal propensity to save this time. So you would do the change in savings, $20,000, divided by the change in disposable income of $50,000, and that's 40%. 40% would be your marginal propensity to save, and that's letter C. All right, what we know so far about aggregate demand is that it measures total spending in the economy. Aggregate demand is the sum of consumption spending, we said. We looked at consumption spending. Now we're going to look at investment spending. Then we'll take a look at government spending. So the investment spending here is all about the business side. Spending on capital items such as, well, include residential construction. Remember, non-residential construction also will be included in investment spending, not consumer spending. Then there's the acquisition of business property, plant, and equipment. That's investment spending, which is business spending. And also the acquisition of business inventory, all included in investment spending. Investment spending accounts for about 15% of aggregate U.S. spending and tends to fluctuate much more than consumption spending does. So investment spending accounts for about 15% of aggregate U.S. spending, and if you remember, consumer spending about 70% and doesn't fluctuate that much. And that's a good thing. That's what keeps our economy going, even during some hard times, is that the consumer spending accounts for so much of the spending. Whereas in tough economic times, it's the businesses that slow down, and they slow down first. Factors that impact investment spending for businesses include interest rates. That's probably the number one factor that impacts investment spending. Low rates means a lot of spending because businesses can borrow and they could grow, and their loan payments are lower because of low interest rates. What other factors impact investment spending besides interest rates? Demographics, consumer confidence, consumer income and wealth, things like level of existing capacity utilization. What does that mean? Well, whether a company is currently fully utilizing its resources or not, that will impact investment spending. Technological advances will certainly impact investment spending, and current and expected level of sales. And these factors all come together to influence business spending, investment spending. Lower interest rates will increase aggregate demand because buyers can purchase big ticket items on credit with low monthly payments. So if these buyers are businesses, they'll make sure that they purchase more than if interest rates were higher and they couldn't afford the loan payment. So which of the following new construction is considered investment spending? Non-residential construction? Yep. Residential construction? Yep. Both of these are considered investment spending. Letter C is the answer. All right, let's look at aggregate demand again. This time we're going to look at government spending because the government is a big spender in the economy also. Maybe not as big as consumption or investment. Government spending includes purchases of goods and services by all levels of the government, federal government, state, and local governments too. But government spending does not include entitlement payments such as Social Security benefits, unemployment benefits, welfare payments. Why? Because when the government pays that out, they're not payments directly for goods and services. These entitlement payments are paid to individuals, and then when those individuals spend that money, that's going to increase aggregate demand. The spending of the entitlement payments by the recipients, that's what increases aggregate demand, not the government sending out the check. So an increase in entitlement payments to recipients, that would increase aggregate demand. A decrease in entitlement payments to recipients would decrease their ability to spend, and therefore that would decrease aggregate demand. What if the government wants to spend more money on goods and services? Well, that's usually done through government borrowings or by increasing taxes. Too much government spending and not enough tax revenue has led to the huge federal deficit that currently exists, but it does contribute to a robust economy. In macroeconomics, all of the following are considered government spending directly increasing aggregate demand, except what? A says the purchase of a school bus by a city government. Well, that's going to increase aggregate demand. B, the hiring of an independent audit firm by a state government, that's services, right? So aggregate demand increases. The purchase of solar panels by the federal government, that's goods and services. And D, the payment of Social Security benefits to recipients, we said that's not counted. So letter D is the answer. The spending of entitlement payments by the recipients, that's what increases the aggregate demand, not the payment to the recipient. All right, which of the following is likely to result in an increase in aggregate demand in the U.S. economy? Increase in taxes? No. Increase in taxes means you're going to have less disposable income. Consumption is going to be down. Aggregate demand is going to be down. A is out. B, increase in government spending on goods and services? Yes. C, increase in interest rates? No. When interest rates go up, there's less borrowings because you can't afford the monthly payments. D, decrease in exports? No. Increase in exports would be good, but not a decrease in exports. So B is the answer. Increase in government spending on goods and services, that would likely result in an increase in aggregate demand. Letter B. Which of the following is likely to decrease aggregate demand in the United States? A says increased business investment and decreased government spending. Well, we're looking for a decrease in aggregate demand. Increased business investment wouldn't do it. B, decreased business investment, yeah. And increased government spending? No. We're looking for decreased aggregate demand. C says increased business investment? No. D says decreased business investment and decreased government spending? Yes. Letter D. Which of the following has led to the United States' current federal deficit? A says increased tax revenues and increased entitlement payments. No. The increased entitlement payments, yes. But increased tax revenues, no. See, a deficit is caused by spending more than you have money coming in. So an increase in tax revenues would mean more money would be coming in. That wouldn't lead to a deficit. But C, maybe a decrease in tax revenues, or D, a decrease in tax revenues. Let's start with C. Decreased tax revenues and increased payments, increased entitlement payments. Yeah, that would lead to a deficit. If you're spending more and taking in less, that's going to lead to a deficit. D says decreased tax revenue and decreased entitlement payments. No. Letter C would lead to a deficit. Total spending in the economy is made up of which of the following? Net exports, yes. Consumption, government and business spending. All of these, letter D. Total spending in the economy is made up of net exports, consumption, government and business spending, and total spending in the economy is what we call aggregate demand.